It's raining again.
It's raining again?
Yeah, you have to walk back up in the rain.
Fine. Growing up in Oregon, I swear, it rains like this all summer long. It seems like there. They get about the same amount of rain we do, but it rains almost every day. Just not very much. The torrential rain that we do. I think I like the torrential better. Keeps everything green still. Anyway. Oh, we were doing appreciation, weren't we? There's going to be a review session. Who's coming to the review session? Okay, folks today? 2? I think we're going to have like 5 people. So if nobody shows up, I'm not doing it. Okay? No. Anyway, all of you are way too busy, and you're trying to get things done before you go on break, right? And you have told yourself that, oh, I'm going to watch the video of the review session for break. Make sure you follow through with that, right? Good idea, right? So, the best intentions to begin. So, yeah, anyway. But the main thing is just study over the break. Make sure you learn how to do everything. Anyway, we were doing depreciation, and we'll do I think we'll probably do the quiz like we usual in the review session. So we'll go over the questions that are in there. And that's on chapter 8 as well. And chapter 8. You shouldn't read them. Well, this chapter's not too bad. Really. But the other one kind of gets you a little bit. It's on liabilities, but it's present values, future values, a little bit on annuities. And then in the chapter following that, the bond chapter, we're going to use that big time. So you really need to understand that and get really good at it. And you've done those things before in math classes, right? You've done all the present values, future values, but you probably didn't know what you were doing. And it depends on the teacher you had. If they gave you real life examples, or they just said you do mathematical formulas and here's an answer, right? So we'll try to put it in real context. Virtually everything in a business setting is valued using discounted present value of future cash flows. Everything's with it. You're going to hire an employee, figure out what the cash flows are going to be as a result of that. How much is going to come in, how much is going to go out, how risky it is, you discount it back to now, and that's how you can figure out how much you're willing to pay them. Not kidding. When UPS buys a truck or an airplane, they do exactly that. When Ford sells them a truck, right, or Airbus sells them an airplane, or whoever does, right, they do it too. They try to guess what the cash flows are going to be, both sides, right? They try to guess what the risk level is, and they try to guess when the cash flows are going to be, and they do a discounted present value analysis, and then that's where they figure the price growth is going to be. What UPS is willing to pay, and what Ford's willing to sell. Otherwise, they can't do business with each other. Now, you still, of course, you want to get, if you're buying, you want the cheapest price possible, and selling the highest price possible, so you still negotiate that. But you start fairly close together, because otherwise, no one even bother to talk to you. You guys do know that when you go to a car dealer, you don't pay the sticker price, right, on the car. You don't even pay the sales price usually. It's meaningless too. Okay, they usually sell for less than their sales prices. Right? It's just sort of the game, right? So, business to business, we try not to do that to each other. We try to be a little more transparent. Still want the best deal you can for both sides. Okay, anyway, let's do depreciation though. We didn't do straight line or declining balance, did we? I'm sorry. We didn't do some of the year's digits or declining balance, did we? So let's do those. And what do we have? What was our example? The piece of equipment.
So the truck, worked for 4 years. And you're going to sell it for.
Okay, so it's a truck. The truck's cost? 120. We're going to sell it for, or we think we are, the residual value or salvage value is how much? So our depreciable value must have been. These terms are getting real easy for you, aren't they? As in you know them versus memorizing them. Yeah, anyway. Okay, so 100,000. And then we said the life was
4 years.
4 years we used? Okay. And we did straight line, I guess, and we did units production, didn't we? So let's do some of the year's digits. This is really a old tax method that's not allowed for tax purposes anymore. But companies used to use the same methods for their financial statements they did for their tax returns and had to. Sort of like the LIFO, FIFO thing, right? And had to. But now you don't have to. So nobody uses their tax method for financial statement purposes. Mentioned that last time, right? There's makers, modified accelerated cost recovery system, really rapid depreciation. It's a tax credit. It's not really a measure of how long the assets can last. Okay? All right, encourages people to buy assets. Okay, turn them over. So what we do with some of the year's digits is for each year 1, 2, 3, 4 in this case, we just reverse the numbers. Okay? So what I do is I write 4, 3, 2, 1. Okay, just turn them upside down. That's it. Okay? And then add them up. Sum of the year's digits, you like it? Okay, add them up. What do you get if you do this? 10? I think. Okay. All right. So what is it the first year? 4 tenths. No good. Second year, 3 tenths. So this is an accelerated method, right? But it's just, I don't know, simple. Pretty simple. So what do we mean? 40% the first year, 30% the next year, and so on. 20, 10. And when you add those up, of course, it's going to be 100%, right? So what do you want to depreciate? Do you want to depreciate the depreciable value or the cost? You better do the depreciable value, so you stop when you get to 20. That's it, okay? So what's the first year going to be? So let's do depreciation expense. Let's do accumulated depreciation. And let's do remaining book value, okay? Everybody got it? So what would you do on the first one? It's going to be 4 tenths times what? The 100,000. That's all there is to this. So how much is the depreciation expense the first year? 40,000. Debit depreciation expense, credit. It's always the same entry, isn't it? Debit depreciation expense, credit accumulated depreciation. Everybody agree? Now be careful. The book value is not 100 less 40, right? It's a real common mistake, but it's not. What's the book value of the truck? 120 on the books, and the accumulated depreciation is 40, so its book value is the difference, which is 80. That's it. And we're on a roll, guys. There's just nothing to this. Okay, you want to stop depreciating when you get down to 20, but this method's going to automatically do that. Okay, all right. So the next one is going to be times 102, but obviously it's 30% of 100. So how much is that? 30,000. Debit depreciation expense, credit accumulated depreciation. That'll bring accumulated depreciation up to 70, won't it? What's the remaining book value, everybody? 120 less 70 is 50. Everybody agree with that? Or you could say 80 less than 30 you just depreciated is now down to 50, huh? That's fine too. Okay, everybody seeing this? Not a big deal? Okay. How about 20%? It says 20,000. Debit depreciation expense, credit accumulated depreciation. You got 90 here. What's left? 30. We got 10 more to depreciate, don't we? It's going to work out just fine. Because what's 1/10 of 100? 10,000. Debit depreciation expense, credit accumulated depreciation. You have 100,000, don't you? And what's my remaining book value? 120 less 100 is 20. 430 less 10 is 20. Okay? Somebody agree? Obviously, if I gave you 40 years, this is a pain. It's a little formula for different. Okay. All right? Everybody good? So, let's try. Yeah.
For the fractions for the 70 years, is it always the time?
Oh, no. What if it was 5 years? It'd be 1, 2, 3, 4, 5. First year would be 5/15. It'd be 15. What if it was 6 years? 21, I guess, no? 15 plus 6. Got it? Yeah, but it'll always add up to 100%, right? It'd be 15 15ths to the 5. Okay, good. Good. Good question. All right, gang, let's try declining balance methods then, okay? So declining balance, when we say the double declining balance the author gives you, which is really 200% declining balance, double 200%. That's just one of the declining balance methods. You could do 150% too. And you could do 175, you could do 125%, right? What does that mean? We're talking about the percent, right? Double the percent the straight line would have been. It's double the percent straight line would have been. It is not double straight line. Straight line would have been what in this particular problem that we did? Was it 100 for 4 years? It was 25 a year, wasn't it? Mm-hmm. So is it going to be 50 for the first year? No. That's not how it works. Okay? right? What we're doing is we're taking double what the percentage would have been. So what would straight line have been? 1/4 a year, right? 25%. It's double that. So what is it? Yeah, it's 50%. But 50% of what? 50% of the declining balance. By the way, what if it was 150% declining balance? What would we do? We take the 25 times 1.5. You get 37.5. Got it? This is not hard, is it? Okay? So what do we mean by the declining balance? It's the remaining book value. Okay? So here's year 1, 2, 3, 4. Figure out what this would do. Right? So how much depreciation expense am I going to have? We'll do accumulated depreciation. This is kind of a nice way to set these up. And you can see all the journal entries and a little schedule. And what's the book value? Now the book value is really important. What is the book value at time 0 when you start? The beginning of year 1. What's the book value of this asset? What is the book value? The 120 you paid. So take the full cost. Don't use the depreciable value. This is the only one where you don't use the depreciable value because you're always taking a percent of what's left instead of taking 100% of it over the life. Got it? That's it. Okay? So once you see that, it's not a very big deal. So I've got 50%. So the depreciation is going to be 50% each year of what's left. So what do we start with? 120. What's 50% of 120? 60. So the first year isn't double the 25 straight line is, right? It's double the percentage straight line is. Got it? So it ends up being 60 in this example. Debit, depreciation expense, credit, accumulated depreciation. And what's my book value if I took 50% the first year?
60,000.
Yeah. Wow. And 4-year life is half each year, huh? Everybody good? What would it be if it was a 5-year life? Let's see, 5 years would be 1/5 each year, 20%. Double it would be 40%. Got it? Okay, that's all there is to it. How about a 10-year life? Maybe 10% a year, right? 1/10. Double it, 20%. That's it. Okay? Right? Anyway, okay. So what would we do the next year? It's 50% of what? It's the remaining book value, so 60. Yeah, so 30,000. Debit depreciation expense, credit accumulated depreciation. How much do we have in accumulated depreciation? 90. What's the remaining book value? 120 less 90 is 30. But when did we want to stop, you guys? At 20. We can't go below 20. So what's going to happen in year 3 here? The maximum we can do is 10. What would be 50% of the 30? 15. We can't do that. The max we can do is 10. So you'd say, the debit depreciation expense 10, credit accumulated depreciation 10. I hit my 100, and how much do I have for remaining book value? 20. And how much depreciation would I have the next year and every year thereafter? 0. Nothing. Right? So this would stay at 100. And this would stay at 20 until I sell it. Everybody good? Really what people tend to do, though, is they won't set a salvage value if they're going to use declining balance. So let's say there's no salvage value here. So if we had no salvage value, there'd be no depreciable value, and we just go ahead and depreciate for 4 years. And at the end of 4 years, will there still be a balance left in book value? Yeah, because you're always taking 50% of what's left, so the last year it'll leave half of what was left in there once. Okay? So you'll automatically get a salvage value. Obviously, it's going to be less than 20,000. So let's change it to that. What would that look like? We wouldn't have any of this down here. Okay? So we'd be at the, what was it, 30,000 here? Okay, so we got 30,000. And you take 50% of that in year 3 with you. What's that? 15. Debit depreciation expense, credit accumulated depreciation. Everybody good? And what do we have now? 105. And what's my remaining book value? 120 less 105. Obviously, it's the 15, isn't it? And we'll do one more year, of course, because it's a 4-year life. 50% of 15 would be 7,500. Double what, everybody? Depreciation expense, credit, accumulated depreciation. What's my accumulated depreciation? 12.5. What do I have left? Could you guys do this for me? You don't, huh? So pay attention to which method I asked for. Right? Okay. Straight line. Units per day. Some units digits. Every coming balance. Okay? Get them down. Be comfortable with them. Practice a little bit. Just not a big deal. What if I gave you a problem where I said, tell me what the depreciation expense is in year 3? And I asked you to do double declining balance. That's all I asked for. What would you need to do? You'd have to do it down to year 3, right? And there it is. Okay? What if I asked for it for straight line? Yay. Right? Figure out what it is. What was straight line for this? We said 25,000 every single year, right? You know, you don't only have to calculate it once, you're done. It's the same every year. What if I do it for units of production? You know what it is per unit, and you know what the actual is for a particular year. What would you do? Take the per unit times the actual. Don't worry about how I asked you the question. It seems like if I don't have you calculate everything, people just go crazy and can't answer. The very least you can do is calculate all of it, right? And then pull out the answer you need. What if I asked you for what the balance is in accumulated depreciation at the end of year 2? You'd have to go 2 years, wouldn't you? What if I asked you what the book value is at the end of year 1? That'd be fun, right? It's that one, isn't it? Okay? So whatever you need to do, okay? That doesn't make the problem harder, it probably makes it easier. Just looks different, okay? Not a real big deal. Okay, let's do again, what would the journal entries be if I sold this now, okay? I want to sell it at the end of year 3, okay? End of year 3. Let's do that. Okay. End of year 3, and I'll give you 2 of them. I sell it for $35,000 cash. And B, I sell it for $20,000. Could you give me the journal entries for those? Or maybe I just ask you how much the gain or the loss was. Yeah.
Are you selling it with that value or without selling it?
It doesn't matter. Oh, I see what you mean. Yeah, use these with the salvage value. Yeah. Or without the salvage value, the one we just calculated. Use that one. I apologize. You're right. It would make a difference because you quit depreciating. Yeah. No. So we kept on depreciating it down to what? Where are we at in year 3? All you'd have to do is figure out where you're at the end of year 3, you guys. And this would look like a real hard problem if I asked you. If I said, I bought an asset for 120, right? No salvage value, using double declining balance. And I sold it at the end of year 3, and I gave you 2 amounts they sold it for. You'd look at that problem and think, wow, man, big deal. Figure out what the accumulated depreciation is at the end of year 3, and sell it, right? That's all you really have to do. So what is my accumulated depreciation at the end of year 3? 105. So how much accumulated depreciation do you want to get rid of? 105. And then how much do I have the asset recorded at in the first place? 120. Don't you want to get rid of that? If you don't have the equipment anymore, you got to get rid of the equipment. If you don't have the equipment anymore, of course you get rid of the accumulated depreciation. Otherwise, you have an asset that's 0, less accumulated depreciation of 105 here. Would it be a negative truck or something? It doesn't make any sense. You got to get rid of both of them. Okay? So for both entries, am I going to want to get rid of the truck? Yeah. So if you went to a trucks account, or equipment or something, wouldn't you take, how much was it, 120? Wouldn't you have credit to that either way, with either one of these entries? I think so. What else do we want? Did we just say we want to get rid of? Yeah, the accumulated depreciation, you want to get rid of that. We know it's 105, don't we? So accumulated depreciation, 105. What else do we have? Cash, sure, in both cases. How much was cash in A there? 35,000. How much was cash in B? 20,000. Does my journal entry balance? Of course not. What's the book value of this asset? 15. Uh-oh. So again, I need to one. I guess I was doing it year 2. Have to do another one. What do we have in the first one here? Gain on sale. Yeah, you sold it for 35 and its book value is 15. What would it be? Gain on sale of the difference. 20,000. Okay. and go on your income statement. What would the other one have? It's also a gain. Would it? Gain on sale. If you got 24 and its book value is 15, I bet it's 5. Would a credit to a gain account make sense? Yeah, it's increasing income. Credits, right? Just like a revenue. Okay? All right, I'll do another one then. Let's do C. What if we only got 5,000 for it? What would you do? Loss on sale. Yeah. You're going to get rid of trucks, right? For 120. You're going to record cash, how much? 5. You're going to debit accumulated depreciation to eliminate it for how much? And that doesn't balance by how much? You only got 5 for an asset that's on your books at 15, you guys. How much did you lose? 10. Does it journal into balance? Yeah. And that would be a what? Loss on sale. You know why we call it loss on sale? Because you lost on the sale. Why do we call it a gain on the sale when you have a gain? Because that's what it is. Where do we put those gains and losses? In non-operating income, right? Other income, non-operating income. We have revenues, less cost of goods sold is gross profit, less operating expenses is operating income. And then right after that, there's non-operating gains and losses and other revenues and other expenses. Where it goes. Where it goes. Okay. And then after that, you get net income before tax. Or maybe net income from continuing operations before tax. Then tax expense. Then net income or net income from continuing operations. Why would you say for continuing operations? If you have discontinued operations below it, or extraordinary items, which we showed net of tax. Okay? That was chapter 5. And then we come down to net income, what you'll see on income statements. Okay, well let's do something else, huh? Let's do changing the life of an asset. Okay? Let's say I buy, we're really stuck on trucks. You can have other kinds of equipment here. Okay. Okay. Anyway, let's say the truck costs me $200,000. And I think it's going to have a salvage value of $20,000. Okay. And that's because I'm going to use it for a long time. I think it's got a life of 10 years. It's a long time for a truck. Okay? So what's my depreciable value? 180. And what's my depreciation going to be per year then? If I use straight line. Sorry, I should have said that. How much would that be? 18,000 per year? Okay. Now let's say that, I don't know, 6 years go by. So 6 years. 6 years go by. What do we do every single year? Debit what? Depreciation expense for 18,000. Credit what? Accumulated depreciation for 18,000. So what I've got is a truck on the books included in with the other trucks for 200,000, right? So I might have a few million in there. Okay, lots of millions maybe through UPS. All right, and then I've got accumulated depreciation. I got a lot of dollars in there, but relating to this particular truck, how much do I have? Each year I would have what? 18,000 coming in here, and I would credit 18,000 to accumulated depreciation. Debit depreciation expense, credit accumulated depreciation for 18, right? I do it a bunch of times, as in 6. So at the end of 6 years, what will I have in there? 6 times 18, huh? 108,000. What is the remaining book value right now? 92. 200 less 108, 92. Everybody agree? Okay, now let's say, how many years were left in its life, by the way? 4 years. Let's say we're only going to make it 2 more years. We think it's only got 2 years left. So I'm changing my 10-year life to what? 8. Okay, now I don't go back and restate the prior years. I made the best estimate I could. So this is a change in estimate. So I made the best estimate I could, so it's not an error. If it was a correction of an error, it'd be a prior period adjustment. If you go to retained earnings, you read about that a little bit in Chapter 5. Those of you who take intermediate will really get into this. Okay. But yeah, so you'll see these things in financial statements. I want you to have some familiarity with it. So anyway, find we're not going to go back and restate the prior years. What we're going to do is we're going to account for it in the current year and prospectively into the future. That's it. Okay? So how's this change going to affect us? My depreciation won't be 18 anymore. How many years do I have left now? 2 years. 2 years to spread the cost over. How much do I have left to depreciate? Oh, let's change one other thing. Let's say I don't think I'm going to get 20 for it. Not only is it not going to last as long, but it's not going to be worth as much. I've been really putting miles on this thing, okay? So I'm using the truck out. It's going to be only worth $10,000 a year, right? 2 years from now, I'll sell it for $10,000, right? And my life is only 2 more years, okay? 2 more. Okay? What would you do? What is my book value right now for this truck? 200 less 108 is 92. How much do I want to have in book value when I'm done? The salvage value or residual value. That's now how much? 10. How much do I need to depreciate in these 2 years? Oh, wow. 82,000. I'm doing straight line. By the way, if you're using declining balance methods, somebody use digits or double declining balance or something, or if you're using units of production, it's still work the same way as this, right? Although with units of production, what would happen is you'd use up all the units fast, right? You depreciate it anyway with that. So what would we do? We divide this by what? My remaining 2 years. That's it. So how much is going to be my depreciation each year? In this horrible example, 41,000, right? So you could go either way. You could extend the life, you could shorten the life, you could make the salvage value less, you could make it more. Got the idea? Okay. So it's going to be 41,000 a year. Debit what? Depreciation expense. Credit what? Accumulated depreciation. So what happens? Here's year 7. Here's year 8. What are we going to have in accumulated depreciation when we're done? 190. Does that make sense to you guys? 200,000 truck less 190 accumulated depreciation is 10,000 remaining book value to match my salvage. Nothing to this, huh? Everybody comfortable? Good with this? In the review session, we'll do some natural resources, maybe. You buy it's one of those on the quiz. You buy a coal mine, right? Anybody still wants to buy coal mines? Yeah, anyway, yeah. You buy a coal mine or oil well or something. And what we would do is we would actually debit coal mine, the asset. You don't own the land, you own coal underneath the land. We're going to give the land back at the end, okay? Coal's a rough one because you destroy the land. But oil, for instance, okay? We don't own the land. We don't destroy the land. The whole land, take all the oil out, and then we get the land back. Timber's the same way. You buy a tract of timber, you're going to cut the timber down, you're not going to take the land, right? Cut the timber down. Now they have cleared land. Plant the timber or whatever. Okay. So you own natural resources. What we're going to do with this is deplete it. Instead of depreciation expense, we have depletion expense. So you would debit depletion expense and credit the asset. So if it's coal I'm mining, I debit the depletion expense and credit coal mining, literally, right? And then as I take all the coal out, I think it has how much coal is in the ground, right? As I take all the coal out, I'll record it to depletion expense, okay? That's if I'm using it. If I'm going to sell it to somebody, I debit inventory. That's a little different. Make sense? I'm going to sell it later to them, put it in a pile. If I'm selling it right now, what would I debit? Delivering it to them, recording a sale right now. This is the major cost of getting the sale. Did a debit inventory, what would you do? Go straight to cost of goods sold. You can debit inventory and later sell it, right? Credit inventory, debit cost of goods sold. Or you can just debit cost of goods sold if you're delivering it, you take it out of the ground. Make sense? Okay. So it could be all 3 of those, really. Another thing is amortization expense. Patents, copyrights, called intangible assets. You read about the chapter, or will read about the chapter. Okay. As I use those up, I usually don't credit an accumulated amortization account or an accumulated depletion account. I just go straight to the asset. Okay, so I credit the asset account. Don't have to. You can use an accumulated amortization if you want. So amortization expense is just like depreciation expense, just like depletion expense. Make sense? Okay. Amortization is usually straight line. So you take the life and divide it into the asset, right? And spread it across over its life, just like straight line depreciation. There was a question back there. So, did I answer it? Figured out. That's good. Waited on it. Okay. Thank you. All right. So you got the idea of that, you guys? So there's a few more things in this chapter, but the big thing is, can you get depreciation down? And we already did quite a bit of it early on. Just trying to get a handle of what's going on. Okay, so let's talk a little bit about the next chapter. It's on current liabilities. We really beat up accounts payable already. Did accruals and deferrals. So they're going to put payroll in there. Read it carefully. Look at the journal entries, see problems. I see the stuff that I've got in the quiz. And we'll do a bit in the review session. But what's really hard in this chapter is present values and future values, which you did in math class. I already mentioned that today, right? And when somebody writes down mathematical notation, right, symbols, and you don't know what they mean, what should you do? Ask. Always ask. And I think what really hangs people in math classes from the kids is they're afraid to ask. And they don't know what the letters mean that they're putting on the board. You guys tell me, what does this mean? It's the beginning of the alphabet. Not that much. Absolutely nothing. What if I write this down? Now it's not the beginning of the alphabet anymore. What is it? Suddenly mathematical notation. And you can make A stand for virtually anything you want it to. And the same with B, and the same with C, and the same with anything else. Same with Greek letters. Got it? That's beta. I know it doesn't look like it, but that's beta, right? What's beta? It happens to be the covariance of one stock's return against the market. Covariance of the return of each individual stock against the variance of the market. The covariance of their returns with the market returns. And we use that in finance. And everybody knows what beta means. So do you guys know what beta means? No. Now you do. So you just taught up to a whole bunch of people. Anybody who's working in finance, you're going to use this stuff. In intermediate accounting today, we're going to talk about beta, and we're going to use it. And we use it to value companies. It is going to help us determine what the discount rate is. What interest rate we should discount future cash flow. We're going to use beta as a proxy for a substitute for risk. How would you possibly know that until somebody tells you? Right? So remember, all this stuff's kind of like that. As soon as somebody throws something out there, particularly, how many of you love math? Love math? Okay, yeah, so we got the usual, right? There's actually maybe one or two more in a group this size actually like it. How many of you wish you never had to take another math class as long as you live? At least in your heart you wish that. Yeah, about as many, right? Yeah. But you know what? It's really valuable. So I was always better at writing and communicating than I was at math. You know, the SAT scores and all that crap. You know, ACT you guys do. I think SAT we did on the West Coast. But when I did my GMAT, my graduate management admission test, I sat down and studied basic mathematics, high school math basically, and I became brilliant at math. I also studied English and vocabulary stuff, and I became brilliant at that. You're looking at a brilliant person. I got a really high score on my GMAT. Oh, the first time I took it, I was just sort of smart. Then I set up my coffee table. It was in a book in those days. It wasn't online. And I went cover to cover in a review manual. You can't study for the GMAT, right? Oh, you can study for the test of your knowledge, not a test of your intelligence. So I want to be brilliant, though. I don't want to just study a whole bunch. So let me be brilliant, okay? So I'm a real high GMAT, big deal. So you can do anything you want. But my point is, when you're working, it's really nice if you have the communication skills. You can write, talk, you can interact with people. And oh, by the way, you can crack numbers, right? You get both of those things going, you get an A, right? You're not quite so dependent on everybody else, which is really nice. And when you are working with people with a different skill set, trust me, when I talk to an actuary, I do not know what they know. But when I talk to a marketing person, I don't know what they know either, or a human resource person. And if I were running a company, would I have all of those skill sets working for me? Absolutely. You want to hire people who know stuff you don't know. Why would you hire people who know less than you? That always bothers me. And there's lots of managers who didn't want anybody working for them who knew more than them. I'm like, what? You just don't want your business to do well, or what? You can't possibly know more about everything than everybody else does. That's a ridiculous concept. And even the stuff you become an expert at, you're not going to be as good. When you guys graduate and you go to work, you're going to know more about the current stuff in your discipline than your boss does. Your boss is going to know how to use it, and you won't know how to use it, but you're going to know more about it. But learn, because you just did it. It's going to be true of the more recent years, right? And then, you know what they'll have you do if they have any sense? They'll have you teach them, and show them, and do it for them, and keep them out of trouble. Explain things to them. Yeah, it's fantastic. Remember that when you're old and you're working, right? The other people around you know more than you. They're really fun to work with. You learn from them, and oh, by the way, they make you richer, right? It's really easy if I hire you and you're really well prepared, you got all these skills, and you really bust your ass when you go to work. It is so easy to justify a promotion raise for you. And that's great for me, because guess what? If you're working for me and you do a really fantastic job, I must be a great manager, huh? By definition, isn't that true? Your employees get a whole bunch done. So hire the best people you can. But in the other side of it, be the best you can. So all of you guys that hate English and love math, learn to love English too. It's fun stuff. It's nice to be able to read, huh? Yeah, write a little bit. And then the same thing on the math stuff. Just get rid of that crap, right? And most of us go through K through 12 preferring one or the other, don't we? And when we get to this stuff, some of you guys look at me like, oh no, it's that math stuff again. Conquer, okay? Conquer. So what does PV little zero mean? P stands for present. E stands for value. Little zero, now, times zero. No kidding, that's what it is. I don't know why we put a zero on it. Actually, I do, because you could make it a present value 20 years from now if you want. But for our purposes now, little zero, we're not going to be very useful. But we do that anyway. Value now. Once you realize that, it's what it's worth now. So when somebody asks you, how much are you willing to invest for something? Gee, I think that's asking me for the present value, don't you? What's it worth right now? How much are you willing to buy a truck for? It's present value. Okay? How much are you willing to give up now? Present value. Guess what this one is? Future value. And then we do this little thing. Little n. What does that mean? It might be years, periods, she says, because she's had more accounting, right? Periods, what do you mean? It could be months, could be quarters, could be semi-annually, could be years. Any amount of time you want, but the same amount, right? Okay? So quarters, years, whatever. Okay, so a lot of times years. Okay? So that's future value some number of years from now. Well, guess what that one is? It's the number of years from now. It's going to be the same number. Okay? Got it? In any particular problem. What's this thing? That's the interest. It's the interest rate. Okay? That's my discount rate. If you know any three of those four, you can calculate the other one. Can you do that now? With or without a calculator? I'm making it different. Like a fancy calculator. It's fairly fancy. It'll do present values and future values. Okay? So we're going to get so you can do this really easily. You can sort of do it in your sleep. You really want this, you guys. You really want it, because it's how we value everything. And if you don't know how to do this, other people are going to take your wealth away from you. There are lots of people out there who are trying. They would like to convince you to give them your money voluntarily. And lots of people will, because they don't know what they're doing. They don't know what things are worth. So they'll pay more than it's worth. Or they'll sell their possessions for less than they're worth. That's it. I'm serious. UPS and Ford value that truck before they exchange it. They both do. And the way they value it is with discounted cash flows. Because they want to know how much the other person's willing to do, right? How much they're willing to sell it for, in the case of Ford, and how much UPS is willing to pay. And if you can guess that, you've got a huge edge to negotiate the price, right? You might actually win, as in get a better price than in fact win. Okay, either way, or either side of it. Okay, what does this consist of? Interest let's say we were to go, who looks like they're really high risk? You got a baseball cap. Both baseball caps. You both look high risk. Okay. If you walk in to get a credit card, leave your hat on. That'll be good. Okay. You walk in, and he's even a young guy with a beard. It's even worse, right? That's even worse. An old guy with a beard, it doesn't matter. They're not going to look at me anyway. They're going to look at my investments, how much I've got, right? And what my income level is. You know, they will look at how old I am, like that, but it'd be overridden by some investments, right? And I have a job, okay. Anyway, but you two guys and I, we're going to go down and get a credit card. Do you want to have a credit card, Ron? No? Okay, let's go down and get a credit card. What's their interest rate going to be, and what's mine going to be, you guys? What do you think yours will probably be? 14? That'd be pretty good. Do you have a credit card? Yeah, 14% is really good. Oh, no, it's terrible. It's horrible. No, you don't get to, your parents aren't co-signing you guys?
It's 23.4.
23.4 is pretty standard? Yeah, it's around 23, 24. Certainly 18 if you shop around. By the way, do you want to borrow any money this way? Of course not. You can go get a credit card, though. It'd be good for you. Go get a credit card and then use it. And then at the end of the month, what are you going to do? Pay it every single time. And how much interest will you give? None. And you will have established credit. You do that for a while. Pay it every month. By the way, is it tempting not to pay it? Sure, but you make them rich and you poor. Right? That's how the system works, guys. It does. Right? Those interest rates should be illegal. Right? That high. On payday loans, they can be as high as 200% sometimes. 200% a year, right? They don't borrow for a whole year, of course. It's unbelievable. Just ripping off poor people. Just horrible. Right? And they're desperate. So they'll do
For
it.
that whole $200.
What's that?
For that whole $200 they put on their signs like that.
Yeah, I know. It's unbelievable. Right? That $200 you get to pay them back $600. Are you kidding? Really? Yeah. Yeah. If you took a year, you don't take a year, but you pay them a few days later,
Yeah.
you're going to give them $250. Yeah, it's crazy, and that's not illegal anymore. It used to be. Never use your loss. It's illegal. It's not anymore. So anyway, yeah. So let's say it is. Oh, let's use 18. Let's be optimistic. 14 is real optimistic, right? That would be somebody who has some credit but not very good. These young guys sitting here, all you young guys, you're in the worst risk category. Maybe not the worst. At least you go to college. That might get you a little bit better rate, right? You young women, you do better. How come? Because you're more mature, more stable than on average than men. I've known women who are real mature, who are real unstable, but they still got better interest rates because they're in that group, right? Okay. People always say that boys grow up or mature more slowly than girls, right? Men and women. No. We never mature. Right, guys? Why would we do that? It's all the fun in life. Women are going to take care of us anyway. It'll be fine. Right? My wife's 11 years younger than me, 10 and a half. She's far more mature than me. She takes care of everything. I can just be totally irresponsible. It's great. And, yeah, it's no big deal. I play all the time. That's what I do, right? Come in here and goof off. I make sure I spend as much time here as possible so I don't have to do anything else. Right? Yeah, that kind of thing. Okay. Very irresponsible. So let's say these guys go down and they get 18%, and I go down and I get 5. I don't know. I have no idea what I would get. Okay? We do have credit cards, but I don't know what the rates are anymore. My wife tells me that every once in a while they send us a letter telling us that our line of credit is $25,000 or something more than it was the year before. So I have no idea what it is now. I tell him when he gets to $500,000 on a credit card, I want him to do a cash advance for $500,000, go to the Bahamas, and never come back. What do you think? I'm kidding. He's unethical and dumb to give you that much credit, but anyway, it's funny. So yeah, some of them are over $100,000 here on a credit card.
Yeah.
And the interest rate's almost nothing. And we use them sometimes. And then what do? Actually, we use the Visa all the time. We get, I don't know, cash back or something. She buys crap with it. Because it's free money. No, it's not really, of course. But, we get it back. But we use it all the time. But then what do we do every month? Pay it. Because I don't want to give them 4% or 5% interest or whatever it's for. Right? Okay, anyway. Plus, if you don't pay it all the time, your interest rates go up. It's a strange game, isn't it? Right? Okay, so they'll want you, if you get a credit card, and always pay it. Credit will get better and better when you buy a house or a car. Interest rates are lower, it's easier to borrow. When I bought my first house, I had $10,000 down on a $40,000 house. It'd be like now buying, it's a pretty nice house, too. It would probably be a $200,000 house now with $50,000 down. I went into the bank, I tried to borrow the money, and the guy says, I don't think I can get a loan for you. And I said, what? And I was making, I don't know, $20,000 a year. And I was doing really, really well. That'd be a lot of it now. Anyway, maybe, I don't know, 90,000. I've been out of school for a couple of years. Anyway, I doubled my salary too. Maybe 100. Anyway, he said I couldn't get a loan. He says, you don't have any credit. I can't take it to a loan committee, and they want to approve it because you don't have any credit. And he says, you see how much money I make? My job is I'm a CPA already, right? And I have a 25% down payment. So he went and begged on my behalf and got me a loan. So I immediately got a credit card, right, to get credit. So what I'm recommending to you is get the credit card first. Just don't use it. Well, use it for a while, and pay it. Then get another one and do exactly the same thing with that one. Have several of them. Okay. Works out really good. Okay, anyway, why is the interest rate so much higher? What are they, you guys, compared to me? More what? More risk. More chance. They might turn into a liability. That's true. Okay, more chance of what? Not paying. They're riskier. It's called a risk premium. Okay? I bet my risk premium is pretty small. Theirs is pretty high. So that's one piece of it. What else is there besides risk, though? We want a true return, or a real, or a nominal. Does all mean the same thing? True, real, or nominal. Anybody who's going to be a finance type, this is going to be your world, right? You're going to be an accountant, you are a finance type. Same thing, really, right? So this is going to be your world. True return, most finance, accounting, econ researchers think is 2 to 3%, you guys. That's 2 to 3. And then what else is there? There could be inflation. And you guys think there's no inflation these days because the politicians keep telling us there's no inflation? Well, there really is. Food's going up, right? My wife wants to buy a new car. The same car that she got 10 years ago, I mean, it's almost the same car, the Volvo that she's got. Ours had a $39,000 sticker on it. Now it's 42. That doesn't sound like very much inflation in 10 years, does it? But the one she bought was 31,000 because the economy wasn't very strong then. Now they want 39, 8,000 more for the same car. Lots of inflation. So that's expected inflation. Right now, that's probably nothing, right? It's probably nothing. How do we know that? Because the true return is 2 to 3, and what's called the risk-free right now is about 3%. So if this is 3 and this is 3, expected inflation is nothing. Okay? That's true for them and for me. Okay? But what if I'm paying 5%? What's my risk premium? Approximately. Maybe 2%? What's their risk premium? Maybe 16%? 15%? Something like that? Why would they want 15 or 16 out of them and they only want 2 out of me for the risk? Because I'm not risky and they are. Okay? So for any investment, what happens, you guys? If it's riskier, it's got a higher discount rate. If it's less risky, it has a lower discount rate at any point in time. Okay? So anyway, we'll pick up there next time. Read that chapter, study, try to do those problems. Come to the review if you can, guys.